Hello everybody, my name is John Novak. I'm the CEO, developer of the T3 Fibs ProTrader, and we're going to spend a lot of time in a live class, and I wanted to walk you through the basics of what you're going to learn, see, and really get out of some of the advanced class that we're going to be doing. Number one goal, make more money, period. Money, 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 that's what it's all about. We've had extremely high success. Of every trader who's been in there has been much more successful after taking these classes and implementing these lessons. So I'm really excited to teach them to you. We're going to spend a lot of time on the market flow indicator, and I'm going to walk you through the different rules and looks and things that we're looking for that are going to make you a much, much better trader. We're going to use it for entries. We're going to use it for some strategic management of trades, stop levels, entries, and exit points. And ultimately, we're going to do this in our live Discord class, just to bring this over, just to give you an idea. In our Discord class, we will have a ProTrader live room. There's two rooms. There's an educational room that you get when you start off with our software that teaches you the basics of reading charts, and Mark does a wonderful job of going through the basics. And then this is going to be a premium room where I'll be running the room, and we'll be doing analysis, trades, basically a little bit of everything. In the user guide, we've got a section for the market flow. We're not going to go through that now, but I wanted to just reiterate one point. Market flow signals are going to be when we either have trend trade rules or tops and bottoms. And really specifically, a lot of work we're going to be doing on tops and bottoms. So I wanted to go through real quick and talk about the white paint bars. The white paint bars themselves are the bars that we're going to be super highly focused on when we're doing our trading of any market, S&P, NASDAQ, crude oil, whatever you trade. And the white paint bars are volume breakouts. And what does that mean? It just means that just let me give you the anatomy of the bars real quick. The bars themselves have two little black lines in them. And these two little black lines represent the couple of prices that have the highest average number of contracts traded in that bar. So we call it a high volume area. Not to be confused with our high volume lines that extend out to the right. The high volume lines are a product of the high volume areas, but for right now, we're just talking about the white paint bar and what creates it. So it's a volume breakout to the downside, and then ultimately, if we have a volume breakout to the upside, you'll see a white paint bar going up that obviously is going to have green dots in it, and then you'll see a white paint bar going down. One of the characteristics of the white paint bars is that they alternate. So you're only going to see a white paint bar up, and then you won't see another white paint bar up again until after you've seen a white paint bar down. So it alternates back and forth, right? Up, down, up, down, up, down. There's a bunch of them in there. And then you'll see we have a volume breakout to the upside, and then there wasn't a white paint bar for quite some time, and then there was, and then quickly reversed and back and forth. And we're going to be using these white paint bars as trade setups once we get to that point. And there's two things that you're going to see that happens when you have a white paint bar. The first of which, I'll just go from the top up here. When you have a white paint bar that has a close above the high of the white paint bar, it's going to create a high volume area line, and that's this green line that goes out to the right. And all that is the two black lines, the high volume area from the white paint bar, that area extended out to the right. And when it's appropriate and we've got the right conditions, we're going to use this green line as our entry area. You'll also see many times you'll see a white paint bar down that's followed immediately by a reversal bar to the upside. And we'll also use that for a signal. But again, it's not really a volume breakout. Technically, I guess it is, but it's a very quick reversal. So if the trend is up and we get a white paint bar down followed by an immediate bar up, maybe we'll be going long with that. So we're going to use both of these as signals. We'll use the arrows as signals, and we'll also use the white paint bars as signals. and we're also going to use the high volume lines as signals. And what we're going to end up with, just to kind of give you a quick snapshot overview of the different trades that I'm going to teach you in our class and everything that we're going to be doing. We're going to be doing a white paint bar trade, and for lack of any other fancy term, that's what we're going to call it, just a white bar trade. And the short rule version, I hate doing the verbiage version of it, but we'll do it real quick. Short version is you're going to have a really good top or bottom defined by our Fibonacci areas. And then we're going to look for a white paint bar trade. We're also going to do some momentum style trades, and we call them one up, one down. And again, this is very, very specific looks, very high momentum type trades. We'll get into this, and I'll show you pictures. And then we're going to do two things with the high volume lines. We're actually going to trade as support or resistance with the high volume lines, and we're also going to incorporate what's called a high volume area breakout. Now, one of the things that you're going to find that's very, very important when dealing with the market flow is a section in our user guide for Fibonacci tops and bottoms. Really, really important that you have a very strong grasp of the different types of termination conditions that can cause a market to reverse. And whenever we have these conditions, this is the precursor for one of our white paint bar trade setups. So for example, whenever we have a red Fibonacci and we get to the edge of Fibonacci resistance, and our triggers are weak, this is the time where we're going to be expecting, number one, the Fibonacci area to hold, and then number two, we want to use our market flow white paint bars to get us into a short position as fast as possible so we can take advantage of as much of the move down as the market's going to give us. And you'll see it's going to be the same thing on the top. So here's a different top, but you can see Fibonacci resistance with the divergence pivot stop out. Market trades all the way down to support with, again, the last line of support with very weak triggers is a spot we'll start looking for reversals. If the market pulls back to the large triggers that are wide up, we'll look for white paint bars long. And then ultimately, when we retest these divergence lows, these are really good spots for us to look for white paint bar trades to the upside. So you're going to get a lot of opportunities for these white paint bar trades. We're also going to be doing high volume line trades there too. So it could be one of each. So we'll start first with our traditional HVA short setup, and the rules are really simple. Again, not shown on this chart, but if the market has a good top at Fibonacci resistance, and then our triggers roll over, we're going to use the magenta lines as entry areas for short positions. And the same thing is true in reverse. If we put in a good Fibonacci bottom, and our trigger lines roll up, we'll be able to use the green high volume line generated from the white paint bar way over here. We'll be able to use that line as an exact spot for an entry to take long positions. The really cool thing about high volume area trading, here's an example of a high volume long trade. The really cool thing about it, we have this little box that goes around a range bar. And it tells us, it starts off bigger and then obviously shrinks down as the market goes up or down. But this is the potential range, either up or down, that a 21 range bar could have. When we're trading high volume lines, number one, we have a really good spot to get into a trade. And number two, we can use this little reversal bar marker, range bar finder, if you will, to tell us exactly where our stop is. So if the market continues up, this box will actually shrink and start going up as the market, with each tick as it goes up. So we're going to be able to actually use this to reduce our risk all the way up to just about zero as the market hopefully goes up in our direction. So we're going to be able to define some very specific entries, and we're going to have some very, very small stops compared to what you may be used to with some of your normal trend trading. We're also going to use these Fibonacci tops and bottoms and these white paint bars as an actual entry signal. And, again, we have to go back to, you have to get good at reading your Fibonacci tops and bottoms. But bottom line is, for us, with our signal, a white paint bar signal is if we get one and our triggers are right. And again, we'll go through some trigger line configurations that you're going to have, but short version is the 8-3 triggers need to be crossed up and above the small triggers, and then you're going to be able to take white paint bar long trades, and then usually followed by trend trades. And we're going to be doing the same thing off of the top. And again, these are, you have to really keep in mind when we talk about tops and bottoms. If we, our Fibonacci software is very good at defining tops and bottoms. So once we have a top defined, we want to get in as quick as possible. We don't want to wait for the market to make a big move and then try to sell a pullback. We want to get in as quickly as possible, and that's really what we're trying to achieve with these white paint bar entries and going short immediately after a white paint bar. Usually, as we start to bring in more charts, you'll see when we start making tops and bottoms, you'll have 1, 2, sometimes 3 divergences. Traditionally, the more divergences you have on the bottom, the faster this white paint bar trade is going to happen. It's going to happen, and the market's going to jump really, really, really quickly. So we're going to have to pay attention to the amount of divergence that's happening on our other charts at the bottom, so we're ready to pull the trigger once we get the white paint bar. And again, usually white paint bar trades go up, and then we pull back and get trend trades, and we get a lot more money out of these trades. Just to go through really quick some of the minimum requirements. Obviously, we have to have a Fibonacci top or bottom. We've already established that. But the only other real criteria for us is we want to make sure that these faster 8-3 triggers are crossed down and physically below the small triggers. And that's really all we're looking for. And we're looking to sell this white paint bar area with the expectation that the market's going to go down. One of the common mistakes that a lot of people will make with these white paint bar trades is they get real excited with them. And they'll forget to make sure that the 8-3 faster triggers are physically below the smaller triggers, and they get themselves in trouble. So when we are trading into a Fibonacci and you get the white paint bar down, again, just make sure that your smaller, faster 8-3 triggers are physically crossed down and below your small triggers, and you're going to be doing really, really well. I made a couple of pictures of this because, believe it or not, people make a lot of mistakes with this. Because you see, when we get to a really good Fibonacci area and you're really hyped up and ready to go and getting excited because you know it's going to be a bottom, this first one will tempt you. And it almost always comes down and makes a pivot stop out, more divergence. And then ultimately the white paint bar that's on the correct side of the trigger lines usually is the one that ends up paying the bills. And you'll see it. You'll start to get, you'll get these little white paint bars that are close, and you're like, oh, but the other triggers are down, but they're on the wrong side. And this is really where we want to step back and make sure we're following the rules. And usually they'll make a pivot stop out of the high. The more divergences we have, once we get the correct white paint bar 8-3 trigger combination, we're off to the races and making money. So that's a really good use of our white paint bars from tops and bottoms. And then we're going to start talking about stop logic and trailing stops and things of that nature. We don't just use the high volume lines as support or resistance to buy or sell. We're going to use these lines in the middle of the chart when it's trending as breakout areas. And you're going to see many breakouts, high volume area breakouts in a day. You'll get 2, 3, 4, 5 of them a day. And traditionally what we're looking for is obviously a trend up. And then we're looking for the bar itself that has the high volume lines, the little black lines, that physically get above the magenta high volume line. So it's a breakout. And the breakout's confirmed by the two little black lines that are above it. And then what we're going to be looking to do is we're going to be looking to buy a little pullback to get long with the trend after that high volume breakout. And you're going to see, again, quite a few of these. And then the nice thing about high volume breakouts is once you get one bar down and one bar up, we're going to trail or stop, which we'll talk about that in just a little bit when we talk about stop logic. Again, this is just another example of, the trigger lines are going up, small triggers are up, and the 8-3s are above them. So we're not looking to sell, this magenta line. We're looking for the breakout. And sometimes the breakout bar itself is actually a down bar, where the high volume lines on the bar itself didn't break above it with the white paint bar, so it's not really a breakout yet. It's truly a breakout when these two little black lines are above the high volume area. And then ultimately we see that when the bar comes down, and then we're going long after the down bar in an attempt to obviously take that breakout to the upside. And then also, as we come down and we start making new bars up, we'll start trailing stops, which we'll get into here in just a little bit. Just a word of warning. One of the things that most people do is they say, I want to figure out how to read the dots on the market flow. Get that thought out of your head. You do not have to read the dots in order to use the market flow. There is no such magical formula. So we're only going to be watching high volume lines and white paint bars, and that's all you're going to need. So that's just your little word of warning there. One of the other obviously key indicators that we use is our T3 trigger lines. And I want you guys to rewatch the trigger line video and have a really good understanding of the trigger lines. There's no such thing as knowing too much. And specifically, I wanted to go through the settings on the range charts that we use on our trigger lines. If you're already familiar with our trigger lines, consider it a fast and a slow or a large and a small. But we've really ratcheted up the speed of these things. So all we're plotting is a small trigger line. And usually that's a 20 period linear regression. The faster, we used to call them the super fast triggers, but it's an 8-3. So it's only an 8 bar period setting on these triggers. And they're very, very fast. And they really are good at predicting, number one, the turns a lot faster. And then also defining very high momentum looks for us. And where these 8-3 triggers are located and trending together, either with to the downside or to the upside, is going to control, number one, how much momentum there is, and it's also going to control our entries, and it's also going to be very, very instrumental in our stop logic and what we're doing. Again, when we look at the 8-3 triggers, general rules, you want the 8-3 triggers to physically be above the small triggers. And then ultimately, if they're both crossed up, that's a much better look for us. If we're going to be doing short trades, we want to have the 8-3 triggers physically below the small triggers. Pretty straightforward stuff. But again, I have to say it just to make sure. And then when we're using HVA areas as entries, we want to make sure that we have a good trigger line configuration between our small triggers and our 8-3 triggers. And again, you're going to end up going short in an area like this when our triggers look like this. And then ultimately, as long as the 8-3 triggers remain below the small triggers, the market usually will continue down until you reach your target areas. So we're going to do trade entries based on the 8-3 and small triggers. We're going to do our high volume area work. We're going to do our white paint bar work. And we're also going to be doing our trailing stop work with this trigger line configuration. So it's Very, very important to get used to this trigger line configuration. We're also going to use this trigger line configuration in the management of our trade setups. And again, it's going to be so simple, you're actually going to laugh at it. Whenever the 8-3 triggers and small triggers are trending together, and I put the other large trigger on here just for fun, but you don't really need it. Some people still prefer to have it on, so I left it on this picture just for fun, but you don't have to have it. Anyway, the short version is we're going to, if we go short for whatever reason, we're going to trail our stops behind any one up, one down combination in the market flow chart. So when we get a bar up, we're waiting. So let's say we went short, trend trade short, whatever. If the market comes down and makes an up bar, immediately after the down bar, we're going to trail our stop behind that down bar. And then we're going to leave it alone. And then as long as the triggers are trending together, if we have another up-down combination, we'll trail our stop. If we have another up-down combination, we'll trail our stop. Eventually, we'll have another up-down combination, another up-down combination, and this simple trailing logic is going to keep you in almost every big trade that the NASDAQ's going to throw at you. You're going to end up making some really incredible, very, very big trades in the NASDAQ doing this logic. We're also going to use this same look, this same triggers trending one up, one down logic, and we're going to use it as an entry. So what we're going to be doing is we're going to be watching, number one, for entries. If let's say you took your profit at Fibs and the market breaks through, whenever we have a one up on our market flow chart, if it's into some form of resistance, one-to-ones or mid bands, we're going to use that as an entry area to go short on the way up. So we're going to be getting short at 15,104, give or take. And then ultimately, as we make a bar down on our market flow chart, we're going to be trailing our stop behind that high. So we're going to be getting in with, about an initial 6-point stop on, $120 stop on the NASDAQ. But most of these types of trades end up with about 2 or 3 points worth of risk when all is said and done. So it's going to be a really nice addition to what you're doing. You're also going to see a lot of times when the markets are in a runaway situation, you don't always get the big pullback that you're looking for in the market. And this is where the one up, one down trigger line configuration on our range chart makes it really easy. Again, all we're looking for is a down bar. If there's some form of Fibonacci support there, we're going long. And immediately after we go long, you'll get an up bar, and we're going to trail our stop immediately right below that low. So again, this would be another situation where we'd probably end up with 2 points worth of risk for 15 or 20 worth of profit, and it happens a lot. And this is what it looks like when you're actually doing this live, depending on how your fill comes out on a market order. You're going to be selling the bar up. You're going to be selling it into the resistance. And then remember this little range bar that we talked about that surrounds the... so initially your stop will be a little bit higher. And then as this little box shrinks when the market's going down, you're able to pull your stop down tighter and tighter and tighter. And then ultimately, if it keeps going down, your stop will be one tick above the bar after it closes. So we're going to really be able to control some risk on some of these momentum trades. And then ultimately, when you step back and start really looking at your charts, especially on markets like the NASDAQ is a momentum-based market. Does a really, really, really good job of momentum moves. And if you're, again, if you're not used to the NASDAQ, it's going to take you a little bit of time to get used to it. But the amount of opportunities that it presents is overwhelming once you have the correct tools. The fib areas, the triggers, and the rules in which to trade it, it really becomes absolutely fantastic. So you'll go back and, again, look, this is at 16:02 and literally 30, 40 minutes later. There was short trades, high volume area, longs at the bottom, and then ultimately one down into Fibonacci support for a momentum trade long. The amount of money in these four moves right here is about $1,400 a contract. Haven't added it up, but that's a rough guess. And your objective of making, in our trading plan, we have $800 as our daily objective. We don't see any reason why that's an unrealistic expectation for you every day. And again, you'll see it, over and over and over, and you'll see people who've been in class, they start posting these pictures. And it's simply a momentum trade. And sometimes you get a one down and you're not quite sure about it. It's still okay to go long after the one up and pay a little bit more. Preferably we like to buy on the way down into support. But when there's a lot of momentum, if for some reason you get in a little bit late, it's usually not going to hurt you. So again, there's, the white paint bar trade, the high volume area trade, and then again, we're not going to forget about our normal Nexgen trend trades where we have to have, a good top or bottom, strong triggers, no termination conditions, and entries at areas. We're going to be able to use the logic that we're teaching you now, and we're going to be able to use this on a trend trade. And what we've done is we've added in, so on the NASDAQ, we watch a 34.5, a 13.2 as the main chart, and then we have a 21 range chart. And only for the purpose of trend trades do we have one more higher range chart, which would be a 34 chart. And what we're looking for, and this has been really, really, really consistent and really happy, is we're looking for a one down situation on the next higher time frame to tell us exactly when to get in at the spot for trend trades. So your trend trade rules aren't going to change. You still have to have odds favorable, strong triggers on your big chart. Still have to have the pullback on your little chart. And then ultimately we want to see one bar down on the higher range chart. And you'll see most of the time you'll get a white paint bar down and you'll get another market flow signal up. So you could use this signal up. Preferably we like to get in on the way down at the spot. And again, you don't have to have any new knowledge. All you have to do is just look at your trigger lines, and when they're really strong and you have a bar down, know that your trend trade is usually going to work. Here's another example of trend trade. Again, market's trending up. We pull right back to the spot. Again, another white paint bar down immediately into our trend trade spot, which is very, very, very common. On the next higher up. So let's talk about different markets. So if you were on S&P or crude oil, you trade a 13.251 range chart. So this next higher up chart in that scenario would be 13. So it's just the next Fibonacci number. We prefer the NASDAQ, or I prefer the NASDAQ, because there's 7 million opportunities a day, and you can make a horrifically large number worth of profit every day. And it's not boring. Let's just put it that way. Takes some getting used to the speed if you're not used to it. But again, armed with trend trades, white paint bar trades, one up, one down trades, you're going to have a lot of opportunity to rip the cover off the ball. And essentially, this is what it looks like when you're getting into one of these trades. So we break out of Fibs, we pull back to support. We'll recognize the one down on our larger chart. You'll get in, and then immediately after an up bar, like we said, you're going to be going to pull your stop up. And you'll be able to pull your stop up as that range bar indicator is shrinking on the position. So it'll start out a little bigger, and then at 6 points, and then ultimately this one ended up at 2.5 points risk. And again, when you get these trend trades that continue on for a long way, it's a lot of money. One of the other things that you'll see, which takes a little bit of getting used to, sometimes you have to do a trade more than once. So I've skipped the middle chart. So I've got the 13.2 so we can look at trend trades. Again, this is a really good trend trade look for us with a 1-up bar on our range chart. Triggers aren't quite perfect for this, so if you did take it, it'd be okay, but notice the market made a higher divergence, which is always going to get us out of a position. And then ultimately it went up again to resistance and a pivot stop out, which is perfect. And at the same time, we still were in a 1-up, 1-down situation on our range bar chart. And you'll see this happen a lot. We have the high volume area, we have our triggers, we have Fibonacci resistance. So we want to be in at this area as assertively as possible, trading against the second bar up. So we know exactly where we would have our stop. And then ultimately, as that box shrinks down, you can pull your stop down. So if you're getting in on the way up, you'll be getting in very close to the top. And if the market goes down, obviously we make a bunch of money. If it doesn't, you're going to lose a little bit, of course. But traditionally, when the triggers are really going with you on the range chart, you can pretty much just keep taking trend trades until you finally hit some type of termination spot. The last little piece for trend trades, even the most perfect trend trade spot in the whole wide world with every trigger and every fib and everything else, sometimes you're really closing on the wrong side of all of your 8-3 triggers. And remember, we talked about these triggers. If you're really, really, really above these 8-3 triggers, we want to wait for a close below these triggers. And if it never closes below the 8-3 triggers, we never end up with a trend trade, and we avoid, what most people hate about trend trades is getting run over on that trend trade that doesn't work. Making sure that you've got a down close and something below these 8-3 triggers is going to save you unmercifully on your trend trades. If you're waiting for that logic, sometimes you don't get in at the perfect spot. Obviously, if we have a 34 range chart or a bigger chart, we can get in at the spot. But if you opt not to use that logic, that's fine. You're still going to have to wait for some close above your 8-3 triggers just to be sure. And then once you close above them, get a little pullback, you're into the trend trade a little bit late. But usually being in the trend trade a little bit late in the NASDAQ is still okay. Usually the market continues up and usually does what it's supposed to do. So you're going to basically have two different methods. If the 34 range chart helps, you can get in at the spot. If not, we'll wait for a little close on the 8-3 triggers. And so we've got our trend trades. Ultimately, we're going to have our white paint bar trades from our tops and bottoms. We're going to have our momentum style 1-up, 1-down trades from areas. And then we're also at tops or bottoms or with the trend. Tops and bottoms we'll do HVA trades, and with the trend, we'll be waiting for those HVA breakout trades. So we're really going to add a lot of very powerful techniques to your arsenal. I really look forward to training you guys in the room and showing you some of these trades live. If you have any questions, please let us know. I appreciate your time, and I really look forward to spending some time together in class with you.